Picture the dream for a moment, because it is a good one. You're sitting on a beach with a laptop. The waves are gentle, the coffee is warm, and on the screen, green numbers are ticking up. You buy in the morning, you sell in the afternoon, and money appears today like magic. No boss, no commute, no waiting decades for some boring index to grow. Just you, your screen, and the market handing you a living every single day. That dream has a name. It is called day trading, and by the end of this video, you will understand exactly what it is, why it is so seductive, and what the evidence really says about whether it works. Let us start with what day trading actually means, in plain words. A long-term investor buys a piece of a business and holds it for years. A day trader does the opposite. They buy and sell within the same day, often within minutes, trying to profit from tiny moves in the price. They almost never hold anything overnight. By the time they go to sleep, they are usually back to cash, ready to do it all again tomorrow. They are not betting on a company's future. They are betting on the next wiggle of the line. It is important to be fair here, because day trading is a real activity that real people do. It is not a scam in itself. The stock market genuinely moves up and down all day, and in theory, someone who is fast, disciplined, and skilled could buy low and sell high over and over. The question is never whether it is possible. The question is whether it is probable for you after everything that quietly works against you. And that is where the dream and the data start to part ways. First, let's be honest about why it is so seductive, because the pull is powerful and worth respecting. Day trading promises three things people deeply want. It promises freedom, the idea of being your own boss, answering to no one. It promises speed, money today instead of money in 30 years. And it promises control, the feeling that your success depends on your own skill and effort, not on some faceless company. Slow investing can feel passive, even boring. Day trading feels active, alive, heroic. You are the pilot, not the passenger. But here is where we have to look at the evidence, calmly and without flinching, because the numbers are not kind. This has been studied carefully by serious researchers across entire countries for years. Two finance professors, Barber and Terrance Odean, became famous for a study with a blunt title. They called it, "Trading is Hazardous to Your Wealth." They examined tens of thousands of ordinary traders and found a clear pattern. The more frequently people traded, the worse they did. The most active traders, the ones closest to true day traders, underperformed the simple market by a wide margin once costs were counted. And it gets starker. In another body of research, scientists followed people who try to day trade for a living over long periods. The results were brutal. In one large study of an entire country's day traders, the overwhelming majority lost money. Only a tiny sliver, around 1 in 100, managed to earn more than a basic minimum wage from it consistently. Think about that for a moment. If day trading were a school, 99 students out of 100 would fail to beat the pay of a regular job, and many would lose their savings trying. So why is it so hard when it looks so easy on the screen? The first reason is simple math, and it is relentless. Every single trade costs you something. There are fees, there's the small gap between the buying and selling price called the spread, and there are taxes on short-term gains. A long-term investor pays these costs a handful of times in a lifetime. A day trader pays them dozens of times a day. Even if your guesses were exactly as good as a coin flip, those costs would slowly bleed your account to death. The second reason is who is sitting on the other side of your trade. When you buy or sell, someone is taking the opposite position. And on the modern market, that someone is usually not another beginner on a beach. It is a giant institution with supercomputers, faster connections, armies of analysts, and algorithms that react in millionths of a second. You're bringing a stopwatch to a race against machines that finish before you have noticed a gun. In that contest, the amateur is not the player. The amateur is the prey. The third reason lives inside your own head, and it is the most dangerous of all. Day trading lights up the brain in almost exactly the way gambling does. Each win releases a little hit of pleasure, and that feeling, not the logic, is what keeps people coming back. A few early wins create overconfidence. the belief that you have a special touch. Then the losses come, and instead of stopping, many people trade bigger to win it back, the exact behavior that empties a casino visitor's wallet. The market does not just take your money. It does it while making you feel, for a while, like a genius. Now, contrast all of this with the quiet path this whole series has been teaching. The long-term investor does almost nothing. They buy a broad basket, they add to it steadily, and they let time and the growth of real businesses do the heavy lifting. They pay almost no fees. They are not racing the machines, because they are not racing at all. Warren Buffett put it perfectly. He said the stock market is a device for transferring money from the impatient to the patient. The day trader is the impatient one, busy and stressed, and usually losing. The calm investor